Hey guys, in this video I'm going to show you how to manage your trade when it goes south by doubling down and hedging. I had a lot of people DM me about this. I had a guy message me on my first YouTube video. He says, been following your progress. It's amazing to say the least. Do you want to share the video on how you hedge your calls with puts if the trade goes against you and make money both ways? Love to see where you enter and exit, if that's okay. I've explained this like 1,000 times, so I really wanted to make a video on this. And I use AJ's notes every day. AJ Trader 7 from AwesomeCallsTrading, AwesomeCallsTrading.com. I'm showing you this because this is where I learned everything, and I use his notes to make my plays. So this morning he said, Tesla, another day of fun, gapping flat, do not long unless pop at the open to 662, then look for a nice quick 5 to 7 points to the upside, then watch for topping. If this snaps 658, look for sell-off to 648 to 650 and under, then watch for bottom curl on it. So as you can see at market open right here, I made my green line to enter on calls, which was 662. As you can see right here, if you would have played his call, you could have bought in right here at 663, and you would have made two points. You could have made a little, and I would have been in and out. Like, you could have made $1,000 on 10 contracts right here. So it was a good play, but you didn't have to play that if you didn't want. I mean, that's literally in and out. You would have been in at 833 and you would have been out by 836, and that's it. But on the downside, he said right here, I made the short purple. And so he said if it breaks 658, you can enter a short position. And so right here, it tried to break it. It didn't work. Right here, you could have scalped it. It didn't really work. Right here, it tested it again. Didn't work. Right here, you could have got burned a bunch of times, But right here, at 1038, you could have finally entered the short position at 1038, and you could have wrote it down. Once it broke 658, like buying at 657 at 1041, and theoretically wrote it all the way down to where he said it was going to go to 650. He said it would go to 648, 650, and it hit 650 and bounced. So, you could have been in right here at 1040, been out by noon, by 12 o'clock. So that's only an hour, 20 minutes if you wanted to play that whole move. I would have just scalped it. I would have bought it right here, and I would have just probably sold it right here. Like, that's more than enough, to be honest, But if this didn't fake you out, I mean, you could have made a good bit. Look, I mean, it fell 2-3 channels down, But I'm not the one to ride that out. Maybe if I had a bigger account or if I just had one contract, but I'm buying 10, so I'm just trying to get in and out as fast as possible. But anyway, so that's how his notes played out for this morning. But to answer the question that I've had multiple times, I'm going to give you an example. So I wrote it out here. How to manage your trade when it goes south by doubling down and hedging. So say, right here, I'm going to zoom in, enter Tesla 655 calls at 1152, and you would have paid 9.65. So that would cost you almost $1,000. So this is like on 10 contracts, that's going to cost you $9,650. So if you go to 1152, this is why I'm saying I would have done this. So right here at 1152, I see it break this line, so let's zoom in more. So right here, you know, I see it break this line, so I'm like, okay, I'll enter calls right here. So at 11.52, I would get in calls, and it would cost me 9.65, so 9.65. At 11.52 right here, I would have entered. But look, obviously, if I didn't get out, like I could have scalped it, but say I wanted more because I was greedy, and now it's going south on me. You know, like right here, I'm like, okay, it's going down, it's going down. Definitely not hedging or averaging down right here. You know, y'all are asking, when are you entering? When are you exiting? When are you hedging? Not right here. I'm going to let this happen. And then right here, I wrote down, you know, like I still haven't averaged down or anything. But at 11.56, because of this, it broke this line. I'm going to enter puts. And it would cost me 9.00. So it cost me $900 on 10. Now I'm in $9,000 on 10 contracts right here. Okay, so I'm in puts right here. My calls are not going well at this point. You know, like I could have got out with the long call scalp. I didn't get out. Now it's going south on me and it's tanking. So now I'm just watching it. So wrote down next. So I would just let it play out. Like I'm going to let it just, you know, it could recover. At 11.52 is when I bought the calls. And now I'm in the puts too. So as you can see right here, at 11.56 I'm in the puts. And I get out at 11.58 right here. Right, so I bought the puts at 11.56. But, you know, like at 11.56, you know, you only spent $900 per contract, so $9,000 at this point. If you look at the puts right here, like, you know, it goes from 900, like right here, boom, 900. I mean, like 2 minutes, you know, like it's already at 985. Like it's only 2 minutes. So I mean, on 10 contracts, 85 per contract, that's 850 that you would make on those puts already being out. You know, like you just try to scalp it for a little bit and just see where it goes, but like it tanks and you enter right here and then you sell it right here. And then like I don't know what it's going to do. Is it going to fall more? You know, but I see right here at 12.03 it starts to recover. Not buying right here because like it could be more downside. I'm not going to wait for one candle of green. I could have averaged down right here. It wouldn't have been the end of the world. Double down. But look, a red, more red. So like right here would have been a safer bet at 12.03. And so right here, if I would have doubled down at 12.03, I would have bought these contracts, these calls at 12.03. Let's see. Would have cost $680. Right there. It shows 13:03 because this is Eastern time. I'm in Central time, so it's going to be an hour off. So, you know, I would have averaged down at 680. So let's do the math on that. The first time I bought it was 965. And so when I double down, it's double down, not just average down. So I got to buy 20 more. And so now I have 30 contracts. So I have one at 9.65. And then I have two more at 6.80. That's 23.25. Divide that by 3. So now your average position is 7.75 on 30 contracts. The delta on these contracts is 0.5. So delta is how many points it moves up or down. So in this definition, you know, to get one, you would need 2 points. So my average position 7.75, and like literally I'm just gonna bump it up to the next highest value. So if this was 7.79, I would still set it to 7.8. If this is 7.4, I'm gonna set this to 7.5. Like, I will capture the smallest amount I can without losing money. So in this case, 7.75, I'm going to 7.8, and I'll set a sell limit for 7.8. So at 12.16, it bounces and goes up, and at this point at 12.16, and right here on the options chart, the contract hits 7.8, and it would have just sold my limit. And I would have made 150 profit being in that 24-minute Tesla prison. So total, I would have made 1,000 total profit, 150 on the calls, 850 on the puts. I mean, obviously costly to go in with 30 contracts, very risky play. You have to really just play it smart, enter at the right time, exit at the right time. Still super risky, and if you don't really know what you're doing, I don't recommend it, you know. But if you're a professional trader and you understand the strategy, and you understand that these channels and support and resistance lines really mean stuff, and you see this bounce, you know, I'm looking on Webull charts, I'm looking at a lot of indicators on the 1 minute and 5 minute chart, you know, the 5, 10, and 20 MA. I'm looking at VWAP, volume weighted average price. I'm looking at the super trend line and the 5, 10, and 20 MA. You know, those all matter. Like, those lines are always being tested. I'm looking at RSI, relative strength index. You know, the strength is really high up, the price is high. If it starts dropping, the price can go lower. Obviously volume, looking at that. AO, awesome oscillator, you know, if it's down right here and you see it pinch to the upside, like, might get an upside trend. So if a lot of these, you know, MACD, you know, if you see a signal in MACD right here cross under the histogram bars, that's usually a move to the upside. Now, I mean, it's not confirmed, but that's usually what it means, and it's usually right. So if you see a lot of these confirm, like, that's how I'm making these calls, you know, like. And I props to Sean, my friend Sean Wally, one of my best friends in real life, at @just_the_brain on Twitter. He taught me all that. Like, you can't just be hasty and buy it and average down at random times. You're going to get burned. But that's how I managed to not take a lot of losses by doing that strategy. But like I said, it's really risky. You know, if you don't have a lot of money, don't do it. Or start with a really small core position of 1. Like, instead of going in with 10, buy 1. Then if you have to double down, go to 3. And like, if it goes to a whole channel down below, which it didn't right here, but if you ended up doing it here and it goes down and then it goes down again, you could technically, mathematically rinse and repeat that. But if you have 30 right here, you got to buy double that. Now you have 60 contracts, you have 90. So, but if you only bought 1, then you have 3, then you only have 9. So like, core position is key. You know, if you're buying calls, you want to buy in the lower channels. If you're buying puts, the higher channels. Like, that's just common sense. But you don't know that if you're not a seasoned day trader, you know. So it's just something that I had to learn. And Sean helped me, AJ helped me, and Mark Moses helped me with his webinar. So that's how I learned. I hope this can help someone. So y'all have a good one. Let me know what you think.